Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. We've talked a lot recently about small cap stocks and how they've generally underperformed in the past couple of years. So, of course, as we go through reporting season, there's plenty of interest in these companies, not just for their results, but of course what lies ahead. I wanted to take a closer look at small caps today, the opportunities, the risks, and what to look for. Remember, this is general information only, and you should seek professional advice before making investment decisions. Roger Montgomery is the founder and chief investment officer of Montgomery Investment Management, a great friend of us here at Fear and Greed. Roger, welcome back.
Thanks, Sean. Great to be with you again.
So just get some context before we talk about earnings season and looking ahead. Just how poorly have small caps performed relative to large and mid-sized caps over the past couple of years? What's the starting point?
Well, perhaps the best way to explain it is to just point out that in 2022 and throughout 2023, the PE ratio, for example, the S&P 600 small caps and the Russell 2000 was as low as it had been in the last 25 years.
Wow.
And in fact, the only time it had been lower was during the very depths of the COVID crisis, just as it began, and also during the GFC. So it was really interesting. I found it interesting because what we know through history, if you go back all the way back to the 1970s, is that whenever you get a combination of disinflation and positive economic growth, and we've talked about this here on the program before, whenever you get that combination, then without fail, innovative growth companies with pricing power have done well.
Yep.
And so this time last year, I said that it would be a good year for stocks and particularly for innovative growth stocks, of which there are an ample number in the small cap universe. What happened was that, and part of the reason why I thought it would be a good year was one, because that backdrop existed. I didn't think we'd have a recession, and we didn't. We'd have positive economic growth, albeit anemic, but we would have disinflation. And disinflation is distinct from deflation. Disinflation isn't lower prices. Disinflation is successive lower rates of inflation. So prices increasing at a slower rate. And we had that. And so innovative small companies with growth and pricing power should have done well. They didn't. In fact, the only innovative companies with pricing power that did well were the Magnificent Seven. And all the money flowed into those at the expense of small caps. So it really was a difficult year for small cap investors. But I do think that the preconditions for them to do well still exist. And so I think this year could be a year where we see many of those small caps catch up simply because those Magnificent Seven and other large cap growers have become expensive potentially.
Okay, so we're starting at a valuation point which is lower than what it might normally be, which is always a good thing when you're an investor.
Indeed.
What about earnings season so far? We've had a major takeover from a company called Altium, which has been great, but just parking that for a moment.
One that we own, I should say.
Ah, well done, because they're paying like a 33% premium or something or other on that one.
Which is unusual in the big cap space.
Yeah. Okay, so how have small caps gone so far? Looking from afar, it looks like some of the small cap retailers, for example, might have done a little bit better than we thought. How are you reading it? How have they gone so far across the sectors?
Yeah, well, we came into it with, analysts, I guess, or consensus came into reporting season for retailers with a pretty bearish disposition. And, that appears to have been a mistake for some companies. Not all, of course, but certainly the ones that we like and we've talked about before, and the ones that we think are good quality. So if we look at companies like the online retailers, Temple & Webster and Setire, they've really hit the ball out of the park. And what's more important is that not only have their numbers been robust and accelerated, their revenue and EBITDA has accelerated in the end of last quarter, so into November and December, but their outlook statements are really encouraging as well. And in fact, their trading updates for January have also been more robust than analysts have thought. And then if we move away from the online or the digital retailers into some of the more traditional retailers, for example, like Nick Scali, they've also done extremely well. And part of the reason for that, of course, is that Nick Scali bought Plush. And what's happened is some of the synergies and scale buying benefits that they said would come from the purchase of the Plush network have occurred. And so that's helped with margins. But all in all, it's actually been a better reporting season, I think, than what analysts expected.
Okay, I'll move away from the retailers, but just very quickly, the Nick Scali purchase of Plush, and you said that they found the synergies. That actually says something for management, because many takeovers you hear about synergies, but they don't eventuate.
Yeah, that's exactly right. Anthony Scali is without doubt an excellent merchant. You need a really good merchant in the retail space, and he is that. And let's not forget, Nick Scali is the furniture retailer that created a new way of doing business for furniture retailers in Australia. So it used to be that you walked into a retail store, pointed to a sofa or a couch back then, and then you pick that one up, and they take that off the floor and deliver it right away. And now it's not unusual, and it's in fact entirely acceptable to order a piece of furniture and to wait 6, 12 weeks, even 6 months in some cases. And so, he brought that idea, that just-in-time inventory system, if you like, or not even just-in-time, you'll wait 6 months for it. He brought that to Australia, and that, of course, meant that they could bring down the inventory requirements, they could bring down warehousing costs, and it made the business much more efficient and a more profitable business.
Stay with me, Roger. We'll be back in a minute. My guest this morning is Roger Montgomery, founder and the Chief Investment Officer of Montgomery Investment Management. Okay, so let's move away from retailers in the small cap space. Some of the miners perhaps haven't been so well, particularly the battery metals companies.
Yeah, so we don't like to talk about it too much, but the reality is that there is some pushback now in the EV space, and while we think that EVs will ultimately dominate global car fleets, that's not a universal view. And in fact, the CEO of Toyota, for example, said that the best that we'll get to is about 30% of the global fleet being electric, and that's because there's many places around the world where access to fast charging stations simply doesn't exist. We've also seen police forces in colder climates pull back on their purchase of EVs simply because they're finding them not as reliable in cold temperatures. And also, there's the big news that Hertz, for example, isn't able to sell its used car fleet of EVs, and so have cancelled very large orders of EV vehicles. And so that has meant, there's some questions that have arisen amongst investors about how much lithium will be required, and maybe they're reassessing some of their expectations. But the good news is that what it means is that the lithium price drops. Stocks in the space sometimes get hammered, and sometimes that can be an overreaction to the negative developments, which means that there could still be upside. And the other news in the resource space, of course, is that China has slowed down a lot. In fact, there are some economists who are saying they're in a deflation trap. And what we do know, for example, is that housing starts and construction has plunged. We know that local government funding has plunged as well, and retail is struggling there. And so the growth expectations for China have been reassessed lower, and that means that demand for many of our raw materials has dropped as well.
Okay, let's move into the, am I allowed to put telcos and utilities together? I'm going to, whether I'm allowed to or not. Aussie Broadband is the one that you quite like, isn't it?
Well, we like a lot of the businesses in communications and in cloud storage. So we've been big fans of that theme for a long time. Our small cap team, Gary Rollo and Dominic Rose, that really has been a day one theme for the Montgomery Small Companies Fund when they launched that. And we're seeing some good news in that space. So Megaport, for example, it's a business that provides, if you like, the connections between data centers. So if you've got a global business, you're a legal firm, for example, or any other business for that matter, and you've got head offices all around the world, but you've got one network that you're trying to connect to, or one system of data and documents that you're trying to all connect to have the fastest access, you really need to use a data center that's very close to your offices. But how do you connect them all together? And the infrastructure that connects those together is provided by Megaport. So we've really liked that business for a very long time. And it surprised the market with some very good news, and share price shot up. I think in one day it was up at one point about 30% in a day. And then another one that we like is Macquarie Technology. Used to be Macquarie Telecoms Group. They have a data centre in the Epping area or Macquarie Park area of Sydney, and they've been expanding that and filling it very, very quickly with tier one, real tier one mega-sized technology businesses, as well as the government, Defence Force, the Australian Taxation Office, and so on. So very high quality business, and I think people are starting to understand that these businesses are indeed very high quality with a great tailwind behind them.
When you're thinking about companies like that, Macquarie Technology is an example that's had a CEO that's been there for a long, long time. How much does that matter? The fact that they've got, Richard White's the obvious large cap example with WiseTech. But how much does it matter that you've got a person who's got a lot of skin in the game and experience?
Well, the fact that they're not diversifying away from their businesses, they're saying, the most money that I can make is to have the bulk of my wealth in this company that I'm in charge of and I'm running. And by the way, the thematic is really good. I can see the business doing well. I can see that customers are signing up. I can see that, when we run out of space, we'll be able to charge more as well and raise our prices. That's testament not only to our thesis, but also, to their belief in themselves.
Yeah. Okay. We're out of time. Any other particular small cap that's worth a mention to keep an eye on in the next 6 months, 12 months post earnings season?
Look, I think one sort of definitely off-piste opportunity that might be worth watching this year. Don't go out and buy it, because who knows how it's going to go. But it's a theme that's worth watching. In January this year, and it's a global idea, but in January this year, what we saw is the SEC in the United States approve the listing of ETFs that are backed by spot Bitcoin. Mm-hmm. Now, you might think, oh my gosh, this is ridiculous. What on earth is Roger talking about? Isn't he a quality value investor? Yes, that is true. And I'm not saying that Bitcoin has a fundamental value. I don't think it's a store of value. It doesn't have an industrial use, and I don't think it's going to ever be a reserve currency. But here's the interesting thesis. Once the SEC approved those ETFs, what immediately happened is 11 have now listed just in the last 4 weeks. And the biggest of those, or the biggest of the new lot, is a BlackRock Bitcoin-backed ETF. Now, what's happening is billions of dollars are flowing into these. And in fact, about $1 billion a week of net inflows are going into these ETFs. And when money flows into those ETFs, they have to do something. And what they have to do is they have to buy Bitcoin. So you find money's flowing into the ETF. They're forced to buy Bitcoin. Bitcoin goes up, and guess what? More money flows into the ETF because Bitcoin is going up. Now, I don't know where this ends, and I don't know how long it goes for, but what I do know is this is precisely how bubbles are formed. And so I think FOMO will eventually, the fear of missing out will eventually take over again. We could see a bubble form in these ETFs and in the price of Bitcoin. And so, it's a highly speculative, highly risky idea, but it's an idea that at the moment is small cap or micro cap and global, and an interesting one to watch.
Yes, wasn't it Warren Buffett or someone who's kind of lives by the theory you only invest in stuff that you understand? And I'm afraid I don't understand cryptos.
No, look, I think the blockchain is something that will be transformative, and I just think it's a mistake I think it's distracting that people are trading these currencies. But nevertheless, the money that will flow into these ETFs as more and more people realise they exist will probably push the Bitcoin price up.
Roger, thank you for talking to Fear and Greed.
Always a pleasure. Good to talk with you, Sean.
That was Roger Montgomery, founder and chief investment officer of Montgomery Investment Management. For more information, visit montinvest.com. That's MONTINVEST, montinvest.com. This is the Fear and Greed business interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Have a great day.